Hey folks, welcome back to the channel. It's Liquid here, and we saw a pretty big employment number come out of the US on Friday. The main headline is that they added 254,000 jobs. And what this means for the economy is that inflation may come back stronger than people think. Now, so far, it hasn't done that yet, but the market is already anticipating the higher job numbers to push wages higher. So that's why we have seen the 2-year government bond yield, the Treasury, go from 3.61% to 3.92% in just the past week. If we zoom out a bit to 1 year, you can see it usually floats between 5% and 4%. So it's rare to see such a big spike in such a short amount of time. So what this means is a couple of things. First, because the labor market is stronger than expected, the Federal Reserve won't have to cut interest rates as aggressively as previously thought. The Fed doesn't want to risk high inflation coming back. In fact, some experts, such as this former Treasury Secretary, has publicly said that the Fed's 50 bp cut in September was a mistake, and they should have only cut by 25 because the economy is still looking pretty resilient. The second thing is because of the strong economic data, the US probably won't go into a recession anytime soon, but one thing about jobs numbers is you always have to wait for the revised final figures because this September report is very new and it's what everyone is looking at right now. But these numbers can have huge fluctuations once they get revised. So usually when something is too good to be true, it typically is. In fact, according to a Zero Hedge article, the 254,000 jobs that was created wasn't just 1 or 2 standard deviations above what the median estimate was by economists. It exceeded expectations by the tune of 4 sigma. And we use these numbers to describe how likely a certain event is to happen, and a 4 sigma event captures 99.9937% of all possible outcomes, which means the experts' predictions were so wrong for this month that it could only happen like 1 out of 15,000 times. Realistically, you probably have to wait like thousands of years to see one of these take place, and the United States isn't even that old. So I'm taking this 254,000 number with a pretty big grain of salt because the real number is most likely lower. So let's dive into some of these numbers a little bit to see. Now, if you're new to employment data, the US comes out with 2 of these reports every month. They have an establishment data, and then they have the household data, which are 2 separate sets with differences. For example, one of the differences is that the household data has no duplicated individuals. So for example, if I work as a pharmacist during the day and moonlight as a salesperson in my off hours, I'm still considered as one person being employed. Whereas in the establishment survey, it would count me twice because technically I have 2 separate jobs. So if a lot of people are finding multiple work throughout the survey period, then that's going to give very different results depending on which data set you're looking at. So anyway, all the headlines you see on the news are talking about the establishment data. You can see compared to July and August, September is definitely a standout, but these are the seasonally adjusted numbers, so they have been massaged a bit. The Bureau of Labor Statistics actually advises against seasonally adjusted data because they revise this annually, so it doesn't tell you as accurately what's going on from month to month as the unadjusted data. So if we take a look at the non-adjusted data for the establishment survey, we can see that the total private sector actually lost 458,000 jobs. That's what's happening if you don't adjust for sales, seasonality changes, things like that. So that doesn't sound like a win if you look at it that way. The economy actually shed over 400,000 private sector jobs. Now, even the unadjusted numbers here are still preliminary, which means they will get revised as well. So that's why I'm saying, like, if you look at what's underneath the really strong job report for September, it's not as clear that the economy is doing so well. So it's possible that the bond market is mispricing what's going on in the economy. Now let's take a look at the household data, because here we can see the number of government jobs increased from 21.4 million to 22.2, which is a huge increase. So from August to September, the economy added 785,000 government jobs, but only 133,000 private sector jobs. So according to the household data, most of the new employment last month was in the public sector, which on its own is already quite an anomaly. If you look at the month before that, comparing July to August, the number of government workers actually went down by 176,000, and before that it was up 47,000, and then down 53,000 prior to that. And if you want to see a strong economy that's growing, you want to see more private jobs because that is where value and productivity and innovation happens. And so far, we're not seeing a trend because although the number for the private sector has increased as well, the month before you can see it actually went down, and the month before that too. So there's no clear trend that more people are getting employed over a sustained number of months. In fact, if we zoom out a bit and compare the non-seasonally adjusted numbers and just doing a year-over-year comparison of private jobs, you can see the number actually went lower. So you have roughly 500,000 fewer people working today than a year ago. Now, the government side of things did more than make up for that, gaining about 700,000 more people with jobs. But again, it's not a good sign when you have government doing most of the hiring, or in this case, all of the hiring over the last year because private industries went lower, which is another reason why the numbers for this month is questionable, because why would the government hire more people in a single month than throughout the entire last 1 year period? So I think there's something fishy going on there. Even though the jobs data, especially the establishment survey, looks really good, and for the unemployment rate, it did fall a little bit again from 4.2 to 4.1. It doesn't really mean anything if you have a longer view of the economy, because if I zoom out to 10 years, you can see the unemployment rate after it hit a low in 2023 last year, the trend is continuing to go up, even though you have some ups and downs along the way. So in the short term, you might see interest rates climb even higher. On the 2-year, for example, it could go up to about 4.1, where it will meet previous resistance. But it's much better to use revised numbers and more clear data when they become available than to make trading decisions based on newly released employment data, especially for this past month, September. There's probably some funny business going on. We see bond funds like TLT dropping a lot. And in my previous video, I mentioned how TLT was kind of in a wedge formation. Some people pointed out it might be in a cup and handle, which I can kind of see, but you would expect prices to move higher after the handle ends. Instead, it looks like we could get another backtest at the bottom of this trend line here. And because TLT has fallen below the 50 EMA on the daily chart, I am now neutral and leaning towards bearish if it decides to continue falling. And as I mentioned before, if it falls through this line and breaks down below that, then that's when sell my long positions, because then it's probably going to fall further, as that's what prices tend to do when they break a wedge formation on the downside. But it's still too early to call, so I'm holding my long positions for now. It's just something to be aware of how economic news can move large funds like this. As I mentioned in the previous video, we don't know if October is going to be up or down for the stock market in general, but one thing we can say is that history shows October is going to be a pretty volatile month. So I would expect to see more of these big moves both in the bond and the stock market. But for the fourth quarter in general, so by the end of the year, history tells us that we should still be pretty bullish on that, unless the price action tells us different. So that's it for now. Thanks a lot for watching, and until next time.